Hello, welcome to part two of our sort of wider look at the central banking system. And yeah, just hope everything's going okay. You know, this is all sort of crazy times. It would be good if I heard from more of your groups about the possibility of doing a sort of online presentation. You know, just come back to me and let's discuss it. I've heard from a couple of groups, but that's it thus far. Today I'll be uploading another homework for next week and be presenting a question for Backpack. But apart from that, we'll just be getting on with looking at the role of the central bank. Obviously, this is all about the past. Obviously, the textbooks are going to be rewritten about economics and all sorts of questions of the money supply and things like that in the next year, because obviously we're going through unprecedented times, and it'd be very, very interesting to look at it from a macroeconomic perspective. But probably at the moment you're a bit bored with coronavirus and you just want to get through this semester, and so probably let's just try and concentrate on the course material. And in a way, what happens will happen. Yeah, remember my office hours? I'm still there, 5 to 6 o'clock. No one comes. But I'm there if you need to talk about work or anything. Okay, so let's share screen. Let's find our slides. Here we are. And there we are. So when we finished on Tuesday, we were looking at the way the Fed, the Fed, the Fed manages, expands and contracts the money supply. And we realized that the reason they were doing that was to change the interest rate, and that how key sort of is the interest rate, and how that affects so many things, and so we looked a little bit about the supply and demand of money, what makes the money demand shift, and and how that causes the interest rate to go up and down, because obviously if there's more of something, the price of that thing goes down. And the price of money, remember, over time is the interest rate. And now we want to look at what effect does that have? So let's see. Here we are. So are we there? So let's have a look at monetary policy and economic activity. Yes, so here we are. So obviously the ability of the Federal Reserve, remember this is different from the government. Yeah, it's a government agency, but it is theoretically independent of the government. And so their ability to affect economic outcomes, to affect inflation, to affect aggregate demand, to keep high employment is through their ability to affect the interest rate. And it uses, firstly, the federal funds rate, a short-term nominal interest rate for this. This is the discount rate, the rate at which they can, the Federal Reserve can lend to high street banks, and also, the open market operations, their ability to expand and contract the money supply. These are the two methods they can use to influence the interest rate. And so ultimately what happens, what is the link between the interest rate and aggregate demand? We've gone through this a few times, but let's go through it again. As I always say, I always use the example of Coronado Centre. Obviously, Coronado Centre's closed down now. And, you know, there's talk of like companies like Macy's folding. Some of these big sort of department stores may fold because, even if things reopen in the summer, people will be going there, because of social distancing. But obviously, consumption is very, very related to aggregate demands, and it's very, very related to the interest rate. And as I always keep saying to you, if some person working in a shop in Macy's or one of these places offers you a credit card, you've got to be asking, the first question you've got to ask is, what is the APR? And so obviously the higher the interest rate, the less consumption there's going to be. The lower the interest rate, the more consumption there's going to be. And that's obviously for bigger consumption as well. Houses, you may make the effort to get a mortgage if the interest rate is lower. And then we go even to bigger things when we come to investment, C plus I, remember. And so lower interest rates, firms are gonna start again. I predict probably that the interest rate is probably going to be zero when we reopen the economy, because obviously a lot of business would have maybe gone under. There's going to be a real attempt to get money in the hands of entrepreneurs to start things again, to start shops and, coffee shops when they reopen, bars when they reopen, things like that, And so investment is encouraged by a low interest rate, and also obviously residential investment. On the other side of things, these are all because of lower interest rates. In terms of net exports, higher interest rates attract foreign funds, raising the US exchange rate, causing net exports to fall. In a way, don't worry too much about that. That's something we haven't really looked at. That's international economics, the economics of international trade and currency, that we haven't particularly looked at in this course. So don't worry about that last one. But generally, lower interest rates cause the aggregate demand to shift to the right, because it's causing more consumption and more private investment. And so the Fed conducts expansionary monetary policy when it takes actions to decrease interest rates to increase real GDP. And they're wanting to they're wanting to expand the money supply, to put the interest rate down, they're trying to cause aggregate demand to move to the right, more consumption, more investment, more net exports, because the price of the dollar goes up. But again, don't worry too much about that. Just really understand what's going on with investment and consumption. Okay, but as you see, this is sort of aggregate demand, aggregate supply graph again. As aggregate demand shifts to the right, what can we see happening? If you look on the left-hand axis, you can see that the price level starts to go up. And this is, obviously this whole section is on inflation, unemployment, and the Federal Reserve. Now, ultimately, so unemployment, aggregate demand to shift to the right, unemployment has gone down, but there's this upward pressure on prices. And so, it's been wonderful. The unemployment has, we've got out of this slight recession that's been going on. We're moving towards sort of equilibrium, but then we might start moving even to the right of that into a boom, and that starts putting pressure on prices. And so probably in that last one, we were approaching equilibrium, which was good, even though, prices are creeping up. But look, if that carries on, if the boom just keeps coming on, because remember, let's say the Federal Reserve has expanded the money supply, lots and lots of economic activity is going on, and then obviously banks are loaning out money, so they're creating more money, so the money supply is even more expanding, maybe the interest rate's going down again. This boom is getting better and better, but again, look what's happening. There's a slight, the inflation is starting to come in, and that's bringing a level of insecurity. So even though the government, the federal, government wants this boom to continue because it's good for them, it makes them look good, the Federal Reserve, that's got to think about the long term, thinks, this is getting a little bit, the economy's overheating, inflation is starting to creep back up. Let's change our policy a bit, and then they will do a contractionary monetary supply. They would, in a way, remember what happens when the Federal Reserve wants to expand the money supply. They create more government debt, and then they sell it. They create more money, and they buy government debt on the open market, bring the government debt into the Federal Reserve, and all that money goes into the money supply. If they want to contractionary monetary policy, it goes the other way. So they would be selling government debt, government bonds, government securities, bringing money into the Federal Reserve and out of circulation. And so suddenly there's less money, and if there's less of a thing, the price of it goes up. And so the interest rate starts to go up, consumption will go down a bit, investment will go down a bit, and the economy hopefully will come back into equilibrium. And that will basically stop, the economy overheating and a big recession coming further down the line. So you think, well, why do you want to do that? Surely you just want it to get bigger and bigger, and the boom to go on and on and on. But the reason they do that is to stop inflation, because if inflation starts to rear its ugly head, then a lot of people will stop spending, a lot of investment won't happen, and there'll be a much bigger sort of movement left of the aggregate demand. There'll be some sort of recession. And so really the Fed are caught between these two different policy goals. One, to keep high inflation, to keep the economy moving, but also to stop it moving too much so there's inflation. Because inflation can be very, very damaging. They want to keep price stability so people can plan. They can plan what's happening next year. They can plan what's happening in 5 years' time. Now, it all sounds very, very clever. This, I have friends that work at the Fed, and you think, these are really, really clever people. They know exactly what to do in the economy, and that's true to a certain extent. There's some very, very clever people that work at the Fed. They've really been analysing this for a long time, and it's really unlikely that we're going to get another recession like there was in the early 30s, the Great Recession. But it's not perfect, So in our world of graphs, the Fed are this all-knowing sort of group that know exactly how much to move the aggregate demand, aggregate supply, aggregate demand line through their open market operations, through expanding and contracting the money supply, exactly what's needed. But in reality, that's probably not happening, and so, ultimately, you're not going to knock out recessions. It's always still going to be the business cycle. But the Fed can make recessions milder and shorter, and that's their aim. It's they don't want this enormous boom bust. The aggregate demand shifting to the right and then shifting back to the left. That's not what the Fed want. They want to make them, these movements, these booms and busts, as mild and short as possible. Because as we say, there's always a human cost to any recession, and the longer and the more intense that recession, the more the human cost, and that's what the Fed is trying to avoid. And the other thing is, we haven't got the data in real time. It's all about a lag, and so Ohio, Indiana, Georgia may be in recession, but Washington wouldn't know that. It's only when you get the data in and actually work out, what things are happening, you can actually really understand what's going on. The example is in November 2001, we worked out that the recession had started in March 2001. They only just worked it out, but then it ended. So, the economy is this vast thing, and don't be fooled by when I give you these graphs. It's all as nice and neat as the graphs are saying. Okay, so we've looked at the role of the Fed. What does it do? Its ability to, one, it backs up the financial system. Two, it expands and contracts the money supply to change the interest rate. So one, it's protecting the financial system, it's protecting the banking system. But two, it's protecting the overall economy. And that is the role of the Fed. So what happened? What did the Fed do during the financial crisis of 2008? Because this, in a way, the two roles of the Fed came to the fore. So, again, we looked at this changing mortgage market. We looked at last week that in the past, a mortgage was just something you borrowed some money off a bank and you paid it back. And because of, that it was quite a long-term thing, a mortgage, there's only so many that a particular bank could give. And it was a small, aspect of the market. Well, when I say small, it was, very, very big in terms of the bank's role, but compared to what happened later, it was sort of relatively small. So there was only so many mortgages that could be given out. But because of the federal backing of the mortgage market that happened through, the Federal National Mortgage Association, often called Fannie Mae, and the Federal Home Loan Mortgage Corporation, which is often called Freddie Mac. Basically, ultimately, because the government were backing up mortgages, it became, thought, well, why don't we trade them, in a way, and why don't we start to sort of give mortgages to people that maybe will default on them because the government's going to back them up, And so this allowed much, the whole mortgage market suddenly got very, very interesting because there suddenly was all this new money in it. So remember, in the past, the mortgage was just, you borrowed some money off the bank and you paid that money to the bank. And the piece of paper that was a mortgage was probably in a bank vault, and they knew that over 30 years they would make their money and considerably more off it. And so it was a good business. But then, because these were backed up by the government, you thought, well, why don't we start trading them? Why don't they become a security that we can trade on the open market? And so suddenly, people started making, just an awful lot of money was being made. And this whole idea of the mortgage-backed security, I hope you watched those clips from The Big Short that started to explain to you what a mortgage-backed security is. Started to to resell these to investors, and these new things, these new sort of banking entities came up, investment banks, money markets, sort of money market accounts, um, um, hedge funds all started coming that were trading in these mortgage-backed securities. And it just, and then suddenly all these people wanted to invest in these mortgage-backed securities, and they thought, what's safer to invest in than a mortgage? And I thought everyone was happy, but what they didn't realize is there was all sorts of people just going out there and just giving anyone a mortgage or anyone a loan. And there was this rise of like a subprime sort of loan market. Remember, we looked at the graph last week where, maybe in the early 80s, 4% of mortgages would have been subprime. By 2006, 2007, 2008, that was getting to 25, 30% of these mortgages were subprime. People with no credit history, people with no jobs, nothing. We'll just give you a mortgage because they could then sell that on the open market. Remember? Do you remember? I can't remember the actor, but the Jenga scene from The Big Short. Where they put these AAA mortgages, really good people with credit histories and stuff at the top, and at the bottom it was just nonsense. It was rubbish. People that were clearly going to default on their mortgage, but these were very, very unscrupulous people. And also the ratings agencies that looked at these things were being paid money to really look the other way. It was a really tricky and twisted thing that happened on the whole stock exchange, especially the mortgage-backed security market from about 2003 onwards. And people made an awful lot of money, and people still have that money. But it all went collapse. Remember, was it Ryan Gosling, who's the guy with the Jenga, and suddenly kept pulling them, and bang, it collapsed, and it did all collapse, didn't it, in 2008. And so the Fed were in a position, like, what do they do? And so we looked, I think, that last week. Suddenly it was starting to do all these sort of short-term loans. It was backing up these shadow banks, the shadow banking system, investment banks. And in March 20, so it was giving discount loans to that, and so that would stabilize elements of the financial system. And then it said it would actually loan out 200 billion, this is March 2008, of treasury securities in exchange for mortgage-backed securities. So basically they were saying is like, we'll give you, gold, solid, US debt in exchange for your rubbish that's not worth anything. And you think, oh, well, that's, it's 200 billion for 200 billion, but basically we'll give you this 200 billion, worth of stuff, which is worth 200 billion for, 200 billion worth of stuff that isn't actually worth anything. So again, this was the taxpayer that paid for this, and it was, some people question the morality of this. They say it was these investment banks and stuff that made all this money and caused all these issues, but then they were bailed out, and so suddenly that brought stability to the financial system. And then what happened, and this is quite sort of interesting, in March 2008, the Fed and the Treasury helped JP Morgan Chase. Now, JP Morgan Chase is a very serious sort of investment bank whose people make awful lots of money. The Fed and the Treasury actually stepped in to help them buy another investment bank, Bear Stearns, which was close to failing. And, obviously, morally speaking, people thought, well, why are you bailing out all these rich bankers? The goal was to avoid a financial panic, and if Bear Stearns had gone down at that time, it would have caused a terrible, terrible panic. In September 2008, the government, the Treasury, and the federal government took control of Fannie Mae and Freddie Mac, and again, these people had not acted morally. They've turned a blind eye to a lot of what was going on. But again, the government stepped in to sort them out, because otherwise the whole mortgage, market would have fallen apart. Maybe even the American insurance market would have fallen apart. It would have been absolutely, it was carnage, but this would have been even more carnage. But again, this was all the US taxpayer that paid for all this. Now, in September 2008, what there'd been, obviously, whatever the government does in this time of crisis, there's always going to be people criticising it, and there was critics of the sort of the bailing out of Bear Stearns. It was like seen as like, this is wrong. These rich bankers are being bailed out by the government. This is wrong. This creates a moral hazard. It means that obviously just bankers can do what they want and they'll be bailed out. So they decided, when Lehman Brothers, a big investment bank, started to look like they were going to collapse, they reached out to the Fed to save them. The Fed said, no, we're going to let you collapse. And they declared bankruptcy on September the 15th. Now, remember, I was working in a business in the UK at that time, and I was trying to hold this sort of business together. The whole housing market was falling apart. There was all these terrible things. When I woke up one morning to find that Lehman Brothers had collapsed, that was like the end. Everyone knew that was like, oh dear, this is really bad, and the financial markets just started going crazy. People started selling everything off. Everything started to go really quite crazy. And that's when, again, the Fed moved their policy. And when AIG, a big insurance company, were about to fail a few days later, the Fed reversed course and they stepped in to support the financial system. So in a way, we've just looked at what we looked at last week, but from the point of view of the Fed. And up to now, up to the end of 2008, the Fed was really just working within their mandate. And we questioned the morality of some of it last week. Should they have bailed out all these rich and greedy bankers? That's a totally another question. That's something we can discuss. But the way the Fed distinguished themselves, and it's still something we can sort of discuss now, 12 years later, is what they did after the crash. Now, what happened after 2008? You've had this enormous crash. You've got this big recession about to happen, and what do? And there were two roads to go down. The first, and this is the road that Europe went down, was the road of austerity. Basically, really, cutting everything back, allowing us to go through the recession, cutting down government spending, cutting down government support for things, and just accepting it's going to be bad, and hopefully believing that the economy will rise up to be more lean and more rational in the future. That was the road that Europe went down. The US thought, okay, not only are we the world's biggest economy, but so much of the world's economy rests on us. If we go down the route of austerity, it's going to be destructive for us and for the US well, for the whole, anyone who trades with the US, which is the rest of the world, So to stop a, enormous recession going through the rest of the world that would have been very, very destructive, the United States went the route of quantitative easing. And it's, basically quantitative easing is actually quite difficult to explain. But a lot of quantitative easing, and, I recommend you watch this sort of YouTube, but it's really trying to understand what people do with money in a recession. And normally, in a recession, when suddenly business becomes very, very unstable, what tends to happen is people start to invest in government securities. They want to buy government debt. They want to buy especially long-term government debt where you're getting like 2 or 3%, maybe a year on it, where it's just a solid investment. That's where all the money goes in a recession. And they sort of thought, we don't want money to go there. We want money to be in the hands of the bank manager who's, and we want that bank manager to be making loans. But obviously, the Fed could expand the money supply in 2009, and Mr. Bank Manager would get all that money, and he'd think, I don't really want to loan it out to people because the economy is too unstable. So that all that money that was going to banks was not actually going out into the wider community. You couldn't get a credit card, you couldn't get a loan because the bank managers are too worried, and they were investing in government securities. And so what ultimately, this is, I'm in a way explaining exactly what this YouTube video is explaining, so try and get both. So what quantitative easing did was to buy vast, normally when the Fed is expanding the money supply, it's just buying like 1 or 2 year government bonds, government debt, government debt that will be paid back quickly because it's easy to move. But what happened with quantitative easing is that the government started buying much more longer term debt, 5-year bonds, 7-year bonds, 10-year bonds, 15-year bonds. And so that basically caused the yield, the interest you'd get off that bond to go down. And that stopped banks investing in it and stopped rich people investing in it, and in a way was pushing, basically what they're doing is forcing banks to push their money out and cause it to be invested, making loans and things like that. And this is quite a complex idea, quantitative easing, and I'll be really impressed if you do understand it, but I won't sort of penalize you too much if you don't, because it is very, very complex. But try and watch this YouTube video and about quantitative easing, and maybe do your own research, because it is a very fascinating subject. And so, all this billions and billions of dollars, maybe even trillions, was poured in to the US economy, and ultimately the recession was not so bad. It could have been, don't get me wrong, the 2008-2009 recession could have been worse than the 30s. It was that bad. But quantitative easing ultimately saved the US economy, and it bolstered the world economy. And it did work. I think probably you have grown up in a much more prosperous country. I think 2011 onwards, it's just been growth. Your childhoods would have been blighted if we hadn't had quantitative easing. And it's been the case in places like Spain and austerity and Italy and to a certain extent the UK. went through austerity, and it would have been even worse for those countries if the US hadn't done this quantitative easing. And it had numerous effects, positive effects, but there was a downside, and that's the enormous government debt to a certain extent comes from this quantitative easing, and the fact that if you look at the Federal Reserve balance sheet, they've just got all this stuff it's not going to be easily moved, and the long-term health of the Federal Reserve is not so good because of quantitative easing. Okay, so that's it with the Fed and the banking system. We sort of finished all that, and so we'll have a homework on this and the backpack question, and yeah, and just remember to get in touch with me about these video presentations, and remember my office hours. Okay, wonderful.